Happy New Year.
Is this going to be a happy new year for us, economically speaking? I mean, everyone's looking for that moderation in price pressures. Everyone's looking for, I guess, some sort of right sizing of the labor market. Do we get that?
I don't think it's going to be a very happy year. We are expecting the economy to slip into recession by the end of the year, just due to the lagged effect of the tightening in financial conditions that the Fed has engineered here, as well as the additional rate hikes that they're signaling today and last December. So we do think by the end of the year we will see that very tight labor market that you referenced and that we saw again this morning in the JOLTS report. We do think by the end of the year we actually start to see job loss start to accumulate, again, as the lagged effects of this tightening.
Well, with the minutes that we just got here, is there any sort of reflection in that to you that the Fed is concerned about that lagged effect, the idea that they've done so much so fast and we really haven't had time to digest it?
Yeah, you do see hints of that, but I do think just given the severity of the inflation problem that we're dealing with, they realize that those, the risk of over tightening here is something they just have to swallow and stomach because, again, because the risk of unanchoring of inflation expectations is still there. So I do think, you saw again today, which we've been seeing really for the past maybe month or two, a little more recognition of those lags, that there are two-sided risks now. But nonetheless, I think the message you got here today is more hikes are coming.
Well, let's talk more about inflation and where it actually goes in 2023. Obviously, the Fed is sticking to that 2% target. What sort of timeline do you think it'll take to actually get close to there?
We don't have us getting really close to the 2% target until probably earlier next year. So, if we just go back to the, Chair Powell has been talking about inflation, core inflation in three terms: goods inflation, which has been coming off. I think we probably saw some indication in this morning's ISM report that that's going to continue to come off. Rent inflation, we're not seeing it yet, but there are some leading indicators that by the middle of this year we should see that coming off. And then there's those services ex rent, which they have tied to labor market performance, and I think that's reasonable. And again, we're not seeing that really come off in a convincing way yet, which is not surprising because the labor market hasn't cooled in a convincing way, and wage growth remains pretty strong.
Talk a little bit more about that ISM data, because you saw some of the price pressures easing. You saw demand cooling as well, which I guess in this context is sort of a positive. You still, of course, had the contraction. And there's now the concern about the balance here. How do we sort of tamp down the negative pressures on the economy at the same time without completely tipping us into, if not a recession, a severe recession?
Yeah. So I think what you see in the ISM data is what you kind of expect, which is Fed started tightening in March. We've had new orders, demand declining for 4 months in the ISM. And then today, for the first time in December, we saw production decline. So we're kind of seeing the normal sort of sequence of rates go up, demand goes down, production goes down, and then eventually employment should follow suit.
Though I hate to be a pessimist, though, I also saw employment went up.
Employment went up. Employment went up. I think over time and that's not, again, not too surprising. We still have industrial production near the highs of the cycle. We still have home construction near the highs of the cycle. So we really haven't seen the effects of higher mortgage rates, of a stronger dollar, really hit actual production. But we do think there are early signs that's going to happen. So I do think, even though the spot data is that construction employment, manufacturing employment is still increasing, I think there are leading indicators that suggest that by the middle of this year, we should see both those sectors probably deteriorating.
And when you think about how, it might take a little bit till the middle of this year to sort of see those effects filter through, and you think about the lagged impacts that we know the Fed is worried about, and you think about Kashkari today saying that he'd like to go to 5.4% and then hold there for a while. Do you think that the Fed will actually be able to hold at that plateau for as long as that they would like, or do you think that they might start to see some of the data deteriorate and get a little spooked?
Yeah, I wouldn't be surprised if they hold at their terminal rate for, let's say, a year. Certainly, if you look at past cycles, they have, basically behaved in that manner. So it's not, I don't think, history wouldn't suggest at the first sign of weakness that they're going to blink and cut rates. So that certainly seems to be a big concern of their messaging here, is that the market is pricing in cuts by the second half of this year. That said, I think if the modal forecast plays out here, they can, maintain rates in a restrictive territory even as the labor market does deteriorate.